Good evening, everyone, and welcome to this week's live weekly trade plan. My name is Tim, and I'm more than happy to take you through tonight's webinar. If you are new to this particular session, which we hold each and every week, for the best part of an hour, I guess, but maybe this one tonight might be a little bit quicker than that. What we look at is multi-time frame analysis. Of course, the market's closed, but this is not necessarily a bad thing because it allows us to take stock of what is happening to price, and it enables us to plan for the week ahead, which is the whole point behind this webinar. We will be taking a technical look at weekly and monthly timeframes, and we'll be looking to identify the important highs and lows and genuine levels of support and resistance that we can use in the trading week ahead. So as always, we'll be observing our main 15 liquid global markets plus any other markets you would like us to look at perhaps towards the end of tonight's webinar. So it's good to have you all on board again, and you're all very, very welcome. So if we can start as we always do with our risk warning. Please do just take a quick moment to read through our risk warning and make sure that you are aware of the risks involved in trading financial markets at all times. Okay, so what is multi-time frame analysis, and why is it so important? So multi-time frame analysis is just us looking at price action over different time frames. The reasons why it's so important, we've identified a few, is firstly, you can see more clearly what is happening and who is genuinely in control of each market. So often, even when we look at daily time frames, price action can be somewhat choppy. If you can look at a weekly and monthly time frame, you can get a much clearer picture at that point. Also, the larger the time frame, it's just important to just notice generally the larger the time frame, the more important the genuine level of support and resistance becomes. So it doesn't matter whether you're trading. Sorry, bear with me. It would be a good idea to plug in my laptop, so that's what I shall go and do now. Okay. So that is also very, very important as well. In addition to those two currently up on screen, apologies for that, is that it can show you the important levels where a market is likely to move towards as well. So this is really using multi-time frame analysis to identify sort of no-brainer exits, maybe from a take profit perspective as well. And then finally, which is something we'll look at tonight, actually, when we're looking at the global indices over the last week, they can assist with the identification of trend reversal as well. So often you see trend reversals at smaller time frames, and they grow and grow and grow. But if you get sort of trend reversals over much larger time frames, they're actually far more important to take note of. So a number of reasons why multi-time frame analysis can be a useful tool. Okay, so let's get straight into the charts and let's see what has happened over the course of the last week. And in actual fact, it's a good, when we work with these weekly highs and lows, and what they can add as well is a bit more confirmation to the trades that we do look to take. So we weren't surprised this time last week to have the weekly high and the weekly low, and I'll show it to you on the weekly chart. And this is the dollar index. So we mentioned last week that don't be too surprised if you get a little bit of sideways moving price action over the course of last week, largely because we had some big moves in markets. It was coming to the end of the month, and on a monthly time frame, when you get a normal close like this, you would, looking at last month's candlestick in January, expect continuation to the downside. However, last week's candlestick still had 3 days of the month within it, so we're not surprised to see this kind of sideways moving price action, the first 3 days of the week, and also as well for the first couple of trading days of this month as well. So all we've had is a bit of sideways moving markets, and we're still within the zone of the weekly highs and the weekly lows. So the reason why these levels are quite important is because they can add more confidence to the direction in which these markets are moving. Also, this low now becomes a monthly low. So if we have a look at it on a monthly time frame, There's just a lot more significance to this low, which is probably why this market could fail to break it. So it became a really important level of support. And currently, we are seeing a little bit of indecision in this market. There's been a lot sort of happening on the fundamental side with Davos and also US policy, and just a lot going on with central banks. And so there's a big fundamental events happening in the background behind these markets, and of course they can impact these markets excessively. So this is a weekly time frame, so all we have is a little spinning top, and which just signifies a little bit of indecision. So if I get up my pen up onto the board, so what we're just likely to see is the market bounce off the monthly lows. We've got these highs. We're very likely, if we break these weekly highs, to get a little bounce. Where would we get a bounce to? Previous lows. So in and around this area, which works hand in hand with the 91.43. You know, that is an area where if you get a little bit of momentum coming out of the market, like you see here in these charts, you might get an opportunity to take this market lower from a much higher price. So it just gives you, we'll wait and see. This is the natural sort of pullback point. So what we're not eager to do is to jump in, even though it's kind of a reversal trade. We're not too eager to be jumping into the upside, not for a little while anyway, until we start seeing things like structural failures across the board. Then, you know, buying the dollar makes a little bit more sense from a technical perspective. But we will keep a close eye on these weekly and of course monthly levels. So in actual fact, what we're going to do is we're still going to work with last week's low, but we are going to change last week's high to 89.44. So that's all I'm going to do with this one. So 89.44.5. So we've just brought down, so that's the weekly high, and a break above that may constitute the potential to take this market to the upside, certainly from a weekly level. Okay, so moving along then, so this a lot of the same principles apply actually to a lot of the dollar pairs now. We've had last week's high be maintained, which is also a monthly high as well, and we've had some consolidation for the last week and a half, as you can see up on the screen. So in actual fact, that's likely to continue. So if we go into the weekly chart, we're seeing a slightly higher tendency for the price to actually squeeze higher in the short term. As to whether it'll break the weekly highs, we don't know. We'll just have to wait and see. But for consistency purposes, let's work with the lows, which is the 23.34 level. So that's all I'm going to change. So 23.34. So all we're doing is moving up the weekly low and suggesting that if this market starts to roll over from here and breaks the weekly low, it'll be an extra addition to the confirmation necessary to potentially buy the dollar against the euro. So that's why it can prove to be a little bit useful. The same thing, another thing to draw your attention to actually regarding the euro dollar is the potential for what we call a structural failure. So that's when you get a high in the market bounces off and makes a low, which just happens to be the weekly and the month and the weekly highs and lows. And then when the market attempts to break that high and fails, this now becomes the high, and this becomes the lower high. So, and that is the beginning of certainly a reversal, but more importantly to a bit of trend movement to the downside. So what we'll be looking at closely now is the 123.34, because if this market breaks down to that level, then that is now a serious structural failure in this market and might give us an opportunity to take it lower. So we'll be looking at that 23.34 level very, very carefully. Okay, so that's the euro dollar. So taking that information over to the pound dollar, and again you can see the potential for the structural failure. This is the low now. So again we've failed to make a new high after pushing higher off these levels, and Friday's candlestick actually it's a bit of a bearish engulfing. Actually, you can see the open and the close, really sizable sort of candlestick, which would just could suggest continuation to the downside. Now the major level is the more recent low, and I'll just give you the actual price. It'd also be the weekly low as well, so I'm going to move that shortly. So the 39.87. So that's the level we're going to be looking for. So if we take this information into the weekly time frame, you can see a nice bullish candlestick for 5 weeks, and now we've got a bit of a bearish spinning top, which means if we break the weekly low, we're likely to get a pushback, maybe even to 35.99. So that could represent, you know, a nice trade to the downside if some strength starts to come into the dollar. So so what we'll do is we'll work with the monthly high, you know, pushing prices further, which is very, very possible. But we'll just work with the new low, which is the 39.78. So let me change that one, 39.78. And hopefully you can see why these levels can really help us actually stay out of this quite choppy price action. You know, we've been a little bit patient this week. You know, we've seen the potential for these markets to move sideways. So as a result, we've just needed to apply a little bit of patience and not be too gun-ho with some of these reversal signals, and just give them time to develop, and then you get a much better, higher quality trade, which is really what we focus on. So that's the pound dollar. Now the yen has kind of sold off a little bit, largely to do with the Bank of Japan and some of the rhetoric regarding the Japanese yen, but we've had a little bounce off this level, and we'll look at the euro yen as well very shortly. But so far this is just literally a pullback, and it's interesting to see the close of this market. So the close of this market is quite an interesting technical area, just in and around these lows, and this market has failed to break above it. So let's see if we get a bit of consolidation around this area, or if we just get, you know, very clean continuation back up to the 110.90, which would be which would be a level which would be you know, far more significant. Let's say the 111, basically the 11100. So we'll just wait and see. We would expect continuation for the dollar to squeeze higher. So with that information, let's just have a look at it on a weekly time frame. Again, we're kind of within these weekly bands, and again, it's more for consistency purposes, but let's work with the weekly high. So the 110.47, let's work with that level. So we'll work at 110.47. We just change those levels, and again, this can give us confidence. If the only thing that sort of would concern us is this middle area here between the 114 and the 108. You know, it can provide a little bit of resistance and support as well. So we might get resistance to the upside around this level. So that's what our live trade room will really focus on during the week. Okay, so so as you can see, we're just kind of getting a pullback off these areas. We were selling the CAD against the dollar, and obviously on Friday, we'd already taken a lot of risk off the trade. So it was a very small losing trade. I think it was about £7 or pounds. So from a monetary perspective, it was virtually break even, but we just never really liked this sort of price action, really. Even though Thursday was pushing lower, but couldn't really hold on to the lows or make new lows. So big turnaround. NFP number on Friday was positive for the US dollar, and you can see the impact that had. And this goes to show the importance of managing risk effectively. So when we sold the market, no, I think the market, we sort of sold it, I think, beneath those lows. We initially had our stop loss up here, and we managed it as the market was moving in favor, and then we brought a stop loss right down to these levels down here, and okay, we got stopped out for a small loser, but we didn't expose this much capital, which meant we could have taken a much bigger loss on that trade. So it just shows the importance of managing those trades effectively, because you want to protect yourself against these sort of really big moves. So let's have a look at it on the weekly time frame then. You would have expected continuation of last week's candlestick, so that's why we were happy to be in that trade to the downside. But of course, Friday's price action was very, very positive for the dollar. So we got a nice bullish candlestick in there. Doesn't really tell us an awful lot, because all we've done is we've just moved into significant levels of resistance, potentially preventing prices pushing higher. But we're just going to work with the new weekly low. So last week's low of 22.49, we're going to work with that to the downside, 22.49. So if we break above last week's high, the 2 weeks, the 2 week high of 24.95, it might give us an opportunity to actually buy the dollar against the CAD. But if it breaks down beneath 22.49, we're likely to get some continued selling. And it's just our live trade room will determine whether a trade exists or not. Okay, so the euro yen on a daily time frame, we have market bouncing off support, failing to make new highs for a period of time, get the inevitable little pullback to try and shake buyers out of the market, bit of indecision, and then off it goes, it flies. So you often get that kind of price action, and we've broken new highs now. So now it's just interesting to see if we're going to hold on to those new highs. So with that in mind, we will work with those levels. So we're going to change the weekly highs and the lows in this market. So 137.48 to the upside, 137.48 to the upside, and we can now work with this low, because by the time this market starts to roll back down, you would think this low would become really quite important in this market. So the low, 134.11. So 134.11. So there's the levels in the euro yen. Plus, you can now see that we're actually on a monthly time frame. There's scope to the upside, so you'd expect a nice continued move based on last week's price action. On a monthly chart, there's plenty of scope to squeeze these prices higher. Okay, euro pound. So this is an interesting one. We're still operating within this range. As you can see, we're going to continue to do so. You can see the price has held up, literally exactly to our low, which is really some of the reasons why we obviously love trading support and resistance, because you can see them. So there's traders out there which look at these levels and they look at them as no-brainers, no-brainer buy trades at those levels where the risks can be very, very low. And if you get this sort of price action, you can get really nice moves to the upside. But you've got to be patient with them. They're not trades that come along, every day. So if you're looking for a daily frequency, you've got to really cherry pick those. But they can become really good no-brainers. There is sort of a downward pressure, as you can see with these highs in here. and they keep becoming lower highs as the market moves lower. So let's see if we get a push up to these levels, and then if we just get a little bit of a reversal back down to 86. But while we're in this range, this sort of price moving action, we're kind of not overly interested in trading between these ranges. Although trades would exist, they don't necessarily mean that they're the highest conviction trades we can take. So on a weekly time frame, we're just getting that continuation, and markets like this are just telling you to be very, very patient. You could argue there's an opportunity to buy it as well on a daily time frame. Now the structural failure is actually this level in here. So as you can see, we still haven't quite got to that level yet, but we're not too far off it, and we would expect continuation of Friday's candlestick. So that's what we'd expect. Let's see if the market delivers. So from a weekly time frame, actually, we're just going to work with these bands to the upside and to the downside. So 90.30 to the upside, and 86.86 to the downside, which is exactly the same level as last week's low. So it just shows you how important these levels can be. Okay, so moving on to the indices then. These are the markets that have seen the biggest move over the last week. Not that we're in a position to actually be advocates of selling these markets. I mean, certainly not yet anyway. But you can see the daily price action the last 5 days. We've seen a significant reduction, a lot of volatility in this market to the downside, compounded on Friday. So there's obviously one eye on increasing interest rates, and this is how it can play out in the financial markets. So it's going to be fascinating to see how these central banks are going to deal with soaring stock markets, because we're not so sure they've necessarily got a particularly big handle on it. They may think they do, but a lot of the time these sorts of things can grow their own legs, and it can run away from policy sort of very, very quickly. So they're probably watching this very, very carefully. Now, can we get in and be selling this market and be advocates of selling? The answer is really not just yet. What we're seeing on a weekly is a pretty impressive a bearish candlestick. It's a weekly bearish engulfing, which is very likely to see continuation. It really should be. And if I show you on a much bigger time frame, it's probably the largest sort of weekly move. You can see it yourself, probably since January 2016. So that was the last time we effectively had this major weekly sell-off. Now, as you can see, going back to these areas, is that we got a weekly structural failure, as you can see down here, a nice W formation, and the market has not looked back. So are we likely to see continuation? Yes. Has anything structurally changed as far as bullish markets at this moment in time? No, not necessarily, but we are watching very closely the rhetoric around the increasing interest rates. But certainly last week's developments were a little bit uncomfortable, and I'm sure the central banks are kind of watching very, very closely to see what happens. So that's just going to be our position basically. So the only thing I'd like to do, and just have a look at it on a monthly time frame as well, and it's important to just acknowledge the trend lines that we have going in here, and Friday's price action sort of stopping at that trend line. So that is quite important. And as you can see, it's got a significant amount of conviction to this trade. And for everything we were saying in January about booming markets and seeing incredible growth, and it was the fastest moving markets consecutively at the beginning of any year for, I think it was 34 years or something like that, maybe a bit longer towards the end, because they just kept moving higher and higher and higher. And as you can see, 50% of that is already unwound. So it just shows you kind of, why trading these all-time highs can just be very, very tricky. Now we're just running into these levels. So what I'm going to do is I'm going to take note of the low. So the low is 27.55. We'll just change that. 27.55.55. And those are the lows. And I'm just going to double check these highs. 28.78. And we've got so I'm just going to change that then. 28.78.25. 28.78. 25. So those are just marginally more accurate. So let's see if we get continuation breaking beneath the 27.55. These are definitely markets to be watching now over the next week or two, and we'll see what. And look as well as the volatility. January has like taken off. So we were in a kind of a low volatile state there for quite some time. The majority of last year, as you can see. And now this year has started like a steam train, 100 miles an hour. So that's the market conditions in which we're trading. So you want to sort of take that on board. And the same thing applies across the board, really. We really struggled to break above last week's high, as you can see. And the market has just rolled over to the downside. So, a fairly significant bearish engulfing as well, so that has to be taken into account. Yes, we do have the same sort of band lines in these, but what I'm going to do is I'm going to work with the highs and the lows. So the lows are 25.409, 25.409. So that's to the downside, and just for consistency purposes, we work with new highs. 26.682, 26.682. So those are the highs and the lows. Are we likely to see continuation? Yes, we are. Are we going to be jumping into it? We don't know, is the answer. We're going to sort of bide our time and just reserve judgment just for a little bit longer, just to see what the response is to this kind of move. The FTSE just been a 3-week sell-off, effectively. So, yeah, that's significant in itself. So you can see the move for 5 very, very bearish days. So a really big sell-off in the FTSE. And when these things start to happen, you really need to sort of take note and just think, right, well, there is a lot of volatility driving prices lower. So, the buy the dips is absolutely potential, but you've got to, we now have to see consolidation where it gives us very, very cleanly defined opportunities to get in to the upside if we possibly can. Sorry, Connor, I'm just seeing your message now. If that level had a break and closed below, would you buy the euro dollar? That is, I know you meant to say sell. Would you sell the euro dollar if that level had a break and closed below? Would you sell the euro dollar? So let me just take it. So I'll come back. I'll just come back to the FTSE ever so shortly. So you're meaning the weekly lows now, the 23.34. Yeah, these levels. So this is a structural failure. So yeah, you're absolutely right. You kind of want to see the close beneath that level. However, there is opportunities to obviously put pending orders in between these levels, because often, if these levels break, you can often get a little flush down. So yeah, that's a little bit more of a judgment call. But certainly, if you get a confirmed break beneath the 23.34, it definitely is a much is something that is something that we'd be definitely looking to see. Okay, hopefully that has answered your question there. If not, we can come back to it in a second. The FTSE 100, major sell-off. Let's just work with these levels. You can see we're coming back into a series of levels of support, pushing prices higher. So let's see how it behaves around the 72, 76. But for consistency purposes, let's just work with the lows, which is the 73.34. 73.34. So 73.34, see that level in there. Great stuff. Okay, so moving on to the NASDAQ. Same principle applies. We're going to work with the weekly highs and the weekly lows. So just to be as consistent as we can. So the highs are the 70, 46, 70, 46. And let's work with this low, which is again a weekly bearish engulfing. We can't sort of stress in normal circumstances how bearish this price action has the potential to be. It really does, but these markets are going to have to come off at some point, and I'm just not sure. So let me see, 67.52. 67.52. These markets absolutely have the potential to come off quite considerably. You just have to look at this and suggest, could we see a 5-10% sell-off? Very, very easily. We've just got to be careful. That's all we're really saying at this point. It's kind of the first significant sell-off for over a year, and they're few and far between. So nothing to overly panic about. It'd be interesting to sort of get a feel for the sentiment and the rhetoric regarding some of these global indices. Okay, so the gold market has seen a couple of mini structural failures. Here's the first one, and now on Friday we broke the second one. So that's the first one, that's the second one. So that's when the market fails to make new highs. And you can see that that's happened on 2 occasions now. So from here, we would be expecting prices to continue. If we're looking at this bit of price action, we'd expect it to continue down to the 1300 level, which was a major level of resistance, preventing prices from pushing higher. So we're likely to get a little push back to there. So that might present an opportunity for us in the short term. So weekly levels, you can see the resistance around these kinds of levels. We've seen it on a few occasions. So there could be a good argument for a sell trade in the gold market. So we're looking for 1327. 1327. We're just going to change this to 1327. 26. So, and we work with these highs as well, basically meaning, we're going to give this space to the upside because there's lots of opportunities for this market to run into a little bit of resistance around these areas. So we're quite happy to work with those highs. So last 2 markets then, before I let you guys go for the evening. Crude oil, this low in here now represents a significant structural failure if these prices prevent from moving higher. So we have the high followed by the lower high, and now we're potentially looking at this area in here to see if it's now all changed to the downside, or even on a short-term basis. We would be quite bullish the crude oil over the longer term again, but it is possible to see a bit of a structural failure, although this one didn't last very long before we saw a structural failure actually back to the upside, which was the trade to take. So as you can see, So we're just going to give this market a little bit of patience and just, bide our time with it. What we will do is look at the weekly time frames, and okay, interesting. Do you know what? I want to leave last week's low, which is actually the low of 3 weeks ago, which is the 62.82. The low of last week is 63.65. So we're talking about, kind of an 80 pip weekly low, which is actually beneath last week's low. So we'll actually work with that because it'd be below the ascending line as well, and there would be extra reasons to sell around that kind of level. So that may work higher. Yeah, so is that due to the solid candle higher? Yeah, so to the upside, we had a bit of a pullback and it's failed to make new highs. A bit of Friday's price action sort of pulled back a little bit more than you would ordinarily like. But from here, you're probably likely to see this market just squeeze lower. As to whether this has enough, let's say, sentiment to actually drive prices lower, I wouldn't imagine looking at this price action. So if we're talking about directional bias, it's to the upside. We're just making it aware that there might be, a little bit of support coming in around these lower areas. So therefore, we want to clear that if potentially a trade comes in where we have an opportunity to sell this market down to the $58, for example, before then buying it again. So this is the thing about these markets. You can have a bias to the upside, but they can obviously go through periods of bearish price action for prolonged periods, and you need a certain degree of flexibility. Although sort of trading against the trend presents its own issues. It has, each of those trades have their own characteristics, and we definitely apply a different sort of risk approach to those types of trades. But they can be profitable and consistently profitable with a high degree of conviction with them, largely because a lot of these traders can obviously take profit, and you can benefit from that as well. So it's just very, very useful. So on a weekly time frame, you can see the weekly lows over the last 2 weeks. So we're going to work with those levels to the upside and to the downside. So 66.63 to the upside and 62.82 to the downside. Okay, fantastic. So the 10-year Treasury note. So we've been selling the 10-year notes and the Euro bond as well, and that's what all last week was all about. So we're in a couple of really good trades very, very early on. Let me see if I can just identify some of these levels. Yeah, there we go. So I just wanted to take those away just before we change them. So let's go straight in. So obviously we've got a significant bearish market here, and last week we were looking at these lows and highs, and we've had a really nice explosive move to the downside. So we're just going to work with these new highs and lows. So the high is 122.09. So 122.09. And then to the downside, we're going to work with 120.64. 120.64. So those are the levels, and not that a break above 122.09 would constitute a buy. That may be the case just because this level just above it, 122, are significant levels of support to the upside, as you can see over here in December and February. But they're very likely to become resistance, preventing prices from pushing higher. So shooting star and the Mo candle pattern. Shooting star or Marubozu. Okay. Sorry, which market is that you're referring to? Oh, the T-note. Okay. On a daily, is it? Okay. Let's have a look on the weekly. Yeah, it's a Marubozu kind of open, which I guess is just identifying the open and the high is exactly the same price, but it's more to do with the close or the significance of the close. Let me see if I can show you a Marubozu. None of these candlesticks are exactly what we're looking for. It's just basically when the high and the open and the low and the close are exactly the same. They can just just present opportunities for buyers and sellers, whichever direction that is, to enter those markets. But we'd certainly look at this price action, which is currently 120.78, and we'd just be very much expecting continuation to the downside. And showing you on a monthly time frame, we've broken a significant level. The last time prices were back at these levels, was around 2010. So and a lot of the fundamentals behind these markets as well is very, very bearish, and it's becoming more and more bearish all the time, with central banks looking to increase interest rates. So it's definitely the trade to be in. We've spotted it very, very early. We're happy to be in it. Now we want to see how much profit we can generate from these markets. So for that, of course, we'll need a little bit of patience. It may be something we decide to stick with if we get the price action, or it may be something that we effectively decide to continue to take profit and look to re-enter it on a regular basis. No worries. Okay, so on that note, guys, I'm quite happy to finish up for the evening. Yeah, sorry, I just moved that weekly low accidentally, which is 120.64. 120.64, so I'll put that level back. There we go. So we're working with these weekly high and weekly low in this market. Okay, right. So if you do have any questions, guys, please use your chat box. Don't, feel free to post whatever questions you have in there. I'll get up the dollar index once more. So yeah, just a number of markets to sort of keep our eyes on, basically, this over the next week, and just be careful. We don't necessarily need to go jumping in, but to just bide our time and just wait for those high probability opportunities to arrive. Please feel free to follow us on Facebook, Twitter, and LinkedIn as usual, and quite happy to take any questions. And if you'd prefer to email us at support@TheLiveTradeRoom.com, myself or James or Tasso will be happy to get back to you as soon as we possibly can. Yes, Yanni, good question. Just regarding about ESMA proposals. Yeah, we've been speaking with all of the brokerages, really. It's something for them to worry about. It's not necessarily something for you or me or us to worry about, let's say. A lot of these are about improving practices within the brokerage industry, which doesn't have a great reputation. And they're probably things that they should have done 10 years ago, or maybe even longer. So the regulators have just got round to being able to make sure that practices are fair to their clients. They often on the surface look like they're fair and equitable and really good. And then when you dig below the surface, you realize that in actual fact, that's not the case. And the odds are stacked heavily against us as retail traders. And I suppose the regulators are just now beginning to do something about that. So whether it's marketing practices or whether it's access to leverage or whether it's other transparency in kind of what they offer and how it impacts your P&L or your profit, your ability to generate consistent returns, whatever the case may be. The authorities are now sort of in this consultancy phase where they're actually wanting to sort of clean up the industry. Now it might have impacts for us, meaning we might be entering an environment with reduced leverage. The problem is that's not necessarily a bad thing. In fact, that is a preferable thing. The only problem is those of you with much smaller capital might be restricted from trading certain markets, which is a shame. So the good thing about leverage is it enables accessibility. The bad news is most traders don't know what it is, how it works, and how it impacts their ability to be profitable. So under those circumstances, it's deadly. So that's what the authorities are looking to clamp down on. And so in a word, nothing to worry about. Certainly sort of short term, there might be some changes which might become a little bit inconvenient. But we shall absolutely keep you abreast of that. We do know there's lots of consultation going on at the moment. So unless something is fairly fixed or something that's definitely coming in, we'll obviously discuss it with you as we go. So yeah, watch this space effectively. But that's probably why you're all getting emails. Even the onboarding process with verifying your accounts and things like that. Companies of brokerages have got away with a lot of sort of slackness, let's say, for quite some time, and that shouldn't really be the case anyway. So all of these things are designed to help and assist retail traders in actually trading these markets and getting rid of some of the really poor practices that we all know retail traders have to deal with. So for me, just probably 10 years too late, but at least it looks like it's gonna be coming in. Okay, yeah, my pleasure, Connor. No problem at all. So on that note, guys, then I'm quite happy to let you guys go for the evening. We're finishing up sort of 10 minutes earlier, which is great news. So I'll let you go. Hopefully you can join us during the week. 9 p.m. Monday to Thursday again. We should have a very, very interesting week this week, so hopefully you can join us for that. So enjoy the rest of the evening, and I know the Super Bowl's on tonight, so should be interesting for those of you that are going to stay up and watch it. So listen, I'll let you go. From everyone here at the Live Trade Room, thanks for joining us. Do take care. We'll see you during the week, and enjoy the rest of the evening. Bye for now.